There's been a growing concern that the US economy might be headed for a recession later this year. According to a recent article on CNBC, Deutsche Bank estimates that the odds of the US entering a recession are approaching 50%. That's based upon consumer and business sentiment about our current market outlook, and the majority of Americans say that they're worse off today compared to a year ago, and they're more generally pessimistic about the near future. Trump's tariffs have also raised a lot of concerns, especially within the stock market this year. It's only the month of March, but both the S&P 500 and the NASDAQ are down for the year. JP Morgan has a more optimistic outlook compared to Deutsche, with them only seeing a 20% chance of a recession this year. This is still twice as high compared to what they normally estimate, but the bank points to several good indicators that we've been seeing, including low unemployment and better than expected GDP growth. Regardless of whether we enter a recession or not, given the market's performance this year, a lot of investors are still worried about the direction of the economy. For both dividend and income investors, it's left a lot of people worried about whether their holdings are strong enough to prevail in this more intense market in 2025. In this video, I'll give some high-yielding investment suggestions that are better geared towards those that are very concerned about a recession. Also, just as a side note, I'm not sponsored by any of these companies. These are all my own personal favorite picks. Now, what's great about market turndowns for dividend investors is that they make lower-yielding investments much more appealing. If a dividend stock that's yielding 3% were to drop in share price by 20%, that would sizably increase their stock's dividend yield. Therefore, if you can get in on a company that normally offers a low yield during a correction, that can be a great opportunity. Dividend aristocrats are excellent buying opportunities in these situations. These are stocks that have grown their dividends for at least 25 years in a row, and they're usually safer investments. Although they typically offer lower yields, again because they're considered safer, if you can get in during a sell-off, that can boost their yields, thus making them much more appealing for income. Even boring dividend growth funds like SCHD all of a sudden become more appealing to income investors because of their higher yields. In the case of SCHD, during COVID, its share price fell by more than 30%, yet its dividend was unaffected. Be on the lookout for when these kind of investments go on a massive sale like this. But one of the best ways to protect yourself during a downturn is to make sure that your portfolio is well diversified. It's something you should be doing regardless of how the market is performing because it comes with a lot of really great benefits. Diversifying your portfolio across multiple different asset classes, sectors, and companies within each sector ensures your exposure to any one type of investment is limited. You don't want to put all of your eggs in one basket when you're living off dividends. If there's a downturn in one specific sector or in one company that you own, it won't negatively impact you as much. If a stock you own has a dividend cut, but it's only 3% of your overall portfolio, it won't shipwreck your income. In the case of diversified funds like ETFs and CEFs, they also reduce volatility, so their share prices won't move as violently as individual company stocks. Therefore, if you're really concerned about a recession, I would suggest focusing the majority of your time on diversified investments like exchange-traded funds and closed-end funds. They're the easiest way to diversify your portfolio, since they typically hold dozens or even hundreds of investments depending on what sector they specifically hold investments in. Fortunately, there's a good amount of funds out there that are well diversified and offer large yields, but some are obviously better than others. The first type of high-yielding investments we'll look at is business development companies. Sadly, in my opinion, there are no good monthly paying BDC funds that exist. One of the only ones that I'm aware of is FGB, the First Trust Special Finance and Financial Opportunities Fund. Unfortunately, it has a pretty poor track record when it comes to both share price and dividend cuts. I should also disclose that I personally don't own a BDC fund. I still only hold individual BDC stocks because I'm still confident in this sector and what I hold in my portfolio. This is the case in all these categories that we're going to look at. If you choose to hold individual stocks instead of a diversified fund, you can achieve higher yields and sometimes monthly dividends if there isn't a good monthly dividend-paying fund. However, if you're very risk-averse and very concerned about the possibility of a recession, there's nothing at all wrong with choosing an ETF or a closed-end fund instead of individual companies. That's the whole goal around this video. But with BDCs, you have two different choices in terms of ETFs. The first is the most popular pick, which is ticker BIZD, the VanEck BDC Income ETF. This one does have a pretty solid track record when it comes to dividend growth, although it does hold a number of BDCs that I don't like, including Prospect Capital. My favorite BDC ETF is the Putnam BDC Income ETF. It's still a newer fund, but I do like its holdings a lot more than BIZD. The Putnam Fund holds 24 different business development companies, so it's very well diversified and its dividend track record has been pretty solid so far. In terms of fixed asset holdings, you likely know that I've been a fan of PIMCO for a long time. They offer a lot of diversified closed-end funds that hold fixed income paying assets like corporate bonds, municipals, emerging market funds, and so on. Now, these are riskier investments because they all use leverage, but if you were to ask me what I think is the least risky fixed asset fund by PIMCO, I would probably pick PTY, their Corporate and Income Opportunity Fund. This one uses about 65% less leverage than other funds by this company, including PDI. Another thing I like about PTY is that it's been doing a lot better with NAV recovery this year compared to some of the other PIMCO funds. It also has a pretty solid track record when it comes to their distributions. There's been periods where they've reduced and grown their distributions, but never usually more than a penny each time. But over the long term, it's been a mostly steady investment offering a high yield. Its share price has also been pretty consistent since the early 2000s, with some volatility during the Great Financial Crisis and during the COVID pandemic. But in both cases, PTY fully recovered. Again, I would consider PTY to be the safest pick among this group of riskier investments. The ultra-conservative can just forego this consideration altogether, but since its IPO, PTY has done very well. Now, one of the better investments to hold for risk-averse people would be preferred stocks. Preferreds have a lot of great benefits for investors that like high income. They function like bonds in that they offer a high consistent dividend that's a higher priority than common stock shareholders. Before a company can pay dividends to common shareholders, they have to issue preferred shareholders their dividends first. A good example of this would be New York Mortgage Trust. This company's common shares have gone through many dividend cuts over the past few years. But look at their preferred shares. Because of COVID, this company wasn't even able to pay their preferred shareholders their dividends. Once conditions improved, they had to back pay preferred shareholders their dividends before issuing dividends to common shareholders again. Although preferreds don't offer consistent dividend growth or any meaningful share price gains, they do come with high yields. Instead of owning individual preferred stocks, I always recommend a preferred ETF instead. My favorite continues to be PFFA, the Virtus InfraCap US Preferred Stock ETF. Unlike individual preferred stocks, PFFA pays monthly dividends and have increased their distributions a bit over the past few years. It currently holds 188 different preferred stocks, making it well diversified across different sectors. Another great investment type during economic uncertainties is utility stocks. After all, regardless of the economy or the stock market, people still need to pay their water and electric bills. The reason utility stocks pay higher than average dividends is because they aren't exactly the fastest growing companies. So they often pay good dividends and oftentimes grow them pretty consistently. There are a number of really good utility funds that pay higher dividends, with many of them paying monthly distributions. All of my favorites in this asset category are all CEFs, and they all pay monthly dividends. One pick worthy of consideration would be the Cohen & Steers Infrastructure Fund, ticker UTF. Although this fund focuses on all companies with large infrastructure and not just utilities, this one has a really solid track record. It offers a yield of around 8%, and with the exception of reducing their dividend slightly when they switch to monthly payments, they haven't cut their dividend in more than 2 decades. But my favorite utility CEF is still the Reeves Utility Income Fund, ticker UTG. This one also pays monthly dividends and has never gone through a dividend cut in its entire history. It has run up quite a bit in share price over the past year, and it doesn't yield as much as a result of that, but it's still an excellent utility fund. And with that being said, that's going to wrap up our look at some various holdings that are likely to do better in the event of a recession. We covered a handful of different sectors and well-diversified holdings in each one to reduce risk. I didn't go in depth on any dividend aristocrats or dividend growth funds. There's just too many that exist, and I wouldn't have the time to go through all of them. Obviously, some aristocrats are going to fare much better during a recession than others. But let me know if you hold any of the investments I went over, or if you think there are better alternatives that exist for some of what I listed. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.